So I think the fact that markets reacted so little, in fact, after the news last night, suggests that the decision was very much as expected, and that's not especially surprising given how much work the Fed's put in over the last couple of months to strongly signal that they would be making this decision. And in the grand scheme of things, a 25 or so basis point increase on the Fed funds rate really has very little macroeconomic significance. But it is interesting in these two regards. Firstly, it's a very obvious manifestation of the degree of divergence between the US and the rest of the developed world. The ECB just cut rates in Europe a couple of weeks ago, the Bank of Japan looks likely to be easing again, and the Bank of England doesn't look like it's anywhere close to hiking. So I think divergence will continue to be a theme through 2016. And the second area is the extent to which this hike represents the first step in a broader hiking cycle. And the Fed have signaled to us that they expect to hike 4 more times in 2016. And that's for sure very gradual compared to previous hiking cycles, but significantly more aggressive than the market's currently pricing. And also they eventually expect to get interest rates up to 3.5%, which again is very low by historical standards, but a lot more than the market is currently pricing. And the extent to which they're going to be able to deliver those more optimistic forecasts really depends on how economic data plays out next year, especially on the wage growth front. So that is what I'll be looking at very closely in 2016, wage growth, to try and predict how the Fed will behave from here.